Hello, I'm Andrew Vine, and this is another Café Insights with the Insight Bureau. We're at Traders Hotel here in Singapore, and today I'm in conversation with Dr Yuwa Hedrick-Wong. Welcome.
Thank you.
Good to see you again, and congratulations on recently being appointed the HSBC Distinguished Visiting Professor of International Business at UBC, University of British Columbia.
Thank you very much.
And I believe you're relocating to Vancouver next week.
Yes.
Okay. Now, you've lived in Singapore for the last 15 years or longer, and as an independent economist, business strategist, you've been the Asia Economic Advisor to MasterCard, and now you're their Global Economic Advisor, as well as advising Southern Capital Group and ICICI, and you're also adjunct professor at Fudan University.
Yes, I'm a firm believer of the ancient Roman saying that a slave that has three masters is a free man.
Well, my opening question to you is, given everything that's happened in the world just recently over the last few years, the turmoil, confusion, and sometimes contradictory analysis we've had from economists, is it a good time to say you're actually an economist?
Well, to be honest, Andrew, that's never been a good time to be an economist, in the sense that economics being touted as a science, whereas in reality, in practice, a lot of intuition is required. Human subjectivity comes into play, including all our prejudices and so on. So we do have a credibility gap, there's no question about that.
Well, you have been writing a series of bi-monthly reports for clients of the Insight Bureau, the Global Emerging Markets Service of the Insight Bureau, highly appropriate acronym of GEMS. Now, in the February report, the close-up report entitled The Euro's Fate and Does It Matter for Asia, you argue that the Eurozone crisis was structural in nature, and therefore it was very unlikely that we would see an easy or quick fix. Now, most significantly, the forecast you gave was for an imminent Greek default as its central scenario, and that's exactly what's happened. So what's next?
Well, I think the critical uncertainty today is really, after the latest rescue package, can we expect to see the beginning of the end of the crisis, which certainly is the hope of the ECB, the IMF, and the Eurocrats. I think that is really the burning question today. Looking at some of the details that's available with respect to the agreement. Now, by the way, I should caution that the devil is in the details. The point is that we do not have a lot of details with respect to the agreement reached last week. But based on what we understand, this is not the end, unfortunately. A lot of the important issues remain very opaque and not spelled out. All they have done is to essentially get an agreement that, yes, we were going to put another rescue package together for Greeks, and which involves the private sector to some extent. They bear some of the cost in principle. The market clearly does not believe it. If you look at the Spanish bond, government bonds, and the Italian government bonds that's been issued and auctioned in the market since the agreement has been reached, the cost of funds gone up. They're actually higher than before. So a lot of the initial euphoria with respect to the agreement reached last week evaporated by and large, and I think the market's back to very serious level of skepticism as to the outcome.
And how serious do you think is the banking crisis in Europe?
Well, I think to the extent of the private sector, the bondholders, private bondholders, will have to bear a portion of the cost. These will directly affect the banking sector in Europe. And that's one of the very dangerous channels of contagion that the crisis can spin out of control. At the moment, with respect to, say, take the Greek situation for now, the French banks has the highest exposure, followed by German banks, followed by the Italian banks and the Austrian banks and so on in that order. The point is that I think to resolve the crisis, seriously putting an end to it, will require a significant recapitalization of the banking sector in Europe. There's no escaping that conclusion. So the ECB has been trying to avoid that eventuality, and that's why the ECB has been so steadfast in rejecting private sector participation. That's come to pass, which is our central scenario, that we believe that there'll be some kind of debt restructuring for Greece, as default, whatever label that you want to put on it. That means now the banking sector will be affected. What we do not know, however, is how bad it may be.
So what are the possible ramifications if it really gets as bad as you say it could?
Well, I think the situation will become political as opposed to economic. And I think that is really the conundrum of the Eurozone crisis. When the crisis deepens, then the solution then shifts to the political arena as opposed to some kind of rational economic decision making. Now, what do I mean by the political arena? Very specifically, I'm referring to local politics. That is, can the Greek government or Portuguese government and the Irish government, for that matter, survive? Okay, would they be thrown out by their own voters, whereas austerity bites and so on? Will the German government, will Angela Merkel herself survive if she agrees to keep the cap flowing? Then the German taxpayers, they say, we're not going to buy that.
Yeah.
And in fact, there's all sorts of mechanisms today that we can see in Germany. They can block further rescue efforts. So it's local politics that would literally determine the outcome. Now, from an economic point of view, all I can say is I can point out that we have no evidence that austerity has delivered growth in the last 50 years in developed countries. The IMF recently published a report. Their researchers looked at 170 some odd cases of change in fiscal policy. Austerity, in other words, trying to reduce excess government borrowing and deliver new economic growth. Of the 170 some odd cases, there were 3 successes. In all 3 cases, the premise is massive currency depreciation. I think the highest is a depreciation of some 40%, and this is Italy actually in the early 1990s before the single currency was introduced. Now, so what that means is that we have actually no case today that austerity can deliver economic growth. For the crisis to end, that means that crisis countries have to be able to return to the open market to borrow. And for that to happen, they have to have economic growth or a reasonably promising prospects of economic growth. The recipe prescribed by the European Central Bank and the IMF up to now is the exact opposite. The Greek economy has shrunk since the beginning of 2010 by 5%. I think it's going to continue to shrink. By the end of this year, I think the Greek unemployment will exceed 20%. And if you look at unemployment rate for young people, it's likely to exceed 30%. Now, we have a very volatile mix from that point of view. Young people unemployed, from a political stability point of view, you're really looking at a recipe for a major political upheaval.
Well, that was the formula for the Arab Spring. It was just
Indeed,
the sheer number of young unemployed people.
So that's what we're looking at now. And that's why I think local politics will actually determine the Euro's fate going forward.
One of the questions on people's minds is, is the euro even sustainable? Can it survive this?
Right. Well, from a conceptual point of view, the necessary economic and political infrastructure for a single currency in the Eurozone is clearly been found to be inadequate. The great hope of the architect of the euro was that monetary integration would lead to economic integration that would in turn lead to political integration. And 15 years later, what we found is the opposite. Monetary integration has actually led to the divergence of 2 very different economic models. Now, in the GEMS report, in the February report, I summarized an analytic exercise that we did is try to understand at what level of the euro exchange rate we can achieve a balanced current account in the different Eurozone countries. What we found, astonishingly, is that for Greece, the euro has to be trading at around 34 cents US dollars. For Germany, it's about $2.50. So that sums up the situation for you. Is the divergence that we're seeing as opposed to convergence.
Let's turn to the US. I mean, such a lot of the world relies on the state of the US economy. At best, it looks like we have a slow, jobless recovery in the States. And there's very poor indicators in terms of housing, in terms of job. We're seeing. What do you think is going to happen in the States, and could this derail the global recovery?
Well, Andrew, as you know well, I've been saying that this recovery is not your normal recovery. The business cycle bottoms, okay, when businesses begins to invest again. And that is the absolute essential prerequisite for a sustained recovery. Well, what is interesting in the U.S. is that non-financial corporate sector in the U.S. is flushed with cash. There are different estimates out there, and the ones that I've been using is that at the end of last year, 2010, the non-financial corporate sector in the U.S. was holding collectively something like $1.8 trillion in cash. Now, if they were to unleash that war chest, the recovery will actually accelerate, will get literally a booster rocket. Now, incidentally, the similar situation is found both in Asia and in Europe. Non-financial corporate sector has been very reluctant to spend. And the reason is the uncertainty in the outlook. So without business investment picking up, we're not going to have a normal recovery. In fact, I believe that the subpar economic growth that we've been seeing will actually extend to roughly 2015 before we can see a normalization, okay, of the business cycle. That's what we're looking at. So what we're seeing now is essentially the continuation of this abnormal recovery phase of the business cycle.
At the same time now, those international companies that we meet regularly on our CEO luncheons are certainly looking to the emerging markets for good growth, to look for new opportunities. And that's reinforced by the managers themselves, saying that they are delivering on the promise so far.
Right.
But the emerging markets are inherently risky. Are we sure that this is the right strategy for international companies to be putting so much emphasis on the emerging markets?
Well, there are two responses, Andrew. One, the first one, life is simply relative. Yes, emerging markets, by definition, have a lot of the policy infrastructure still being built. There's a lot of built-in instability in their systems and so on. But to the extent that they're growing fast, they're expanding, where the traditional developed markets not, it's not like you have a lot of options running a company, a global company. But the second response actually is, I think, more important, and that is, at the end of the day, emerging markets today are connected to the developed markets. There's no decoupling as such. So emerging markets cannot go it alone. Right? So therefore, global companies putting all the eggs in the basket of emerging market, hoping that would deliver the future, I would argue is mistaken. You need a balanced approach. Now, at the end of the day, too, is that the U.S. consumer, as bad as the situation is, unemployment rate is at all-time high. Well, guess what? Household consumption is expanding in the U.S. They're rebuilding the savings. The household indebtedness declined from roughly about 136% of the annual disposable income a year and a half ago down to below 120. Business opportunities are there. It's just a lot harder, and you have to compete and work harder to capture those opportunities.
Well, I know that the growth in Asian consumption has been a significant driver. It's what we've all been hoping that would happen in terms of boosting growth potential. But is this slightly overstated in terms of the power of really driving the economy? I mean, surely, from a lower base, the increase in consumption can't possibly make up for the recession in the
Well, from a pure quantitative point of view, the consumer market if you add up all the most significant emerging markets, not only the BRIC countries, but add in Indonesia, add in South Africa, Mexico, and so on. Essentially, then you compare them with the OECD countries, US and Western Europe. Essentially, you're talking about less than about 20% in pure quantitative terms. So you're absolutely right. Emerging markets cannot compensate for the stagnation of consumption. But that's also slightly misstating the situation. I don't think the two are entirely substitutions. Emerging markets actually exhibiting a very distinctive consumer market patterns that are not at all identical to the consumer markets of the countries. So again, global businesses would have to work hard to actually tailor-make the offering in order to capture whatever opportunities there are in the emerging markets to begin with, let alone just look at a pure quantitative substitution for the laws of the market in the developed countries.
I remember, as we were meeting together the last time, that you worried that perhaps international companies would be so relieved to have survived this recession that they might miss the point in terms of the true nature of Asia's recovery. And things have changed and probably changed forever. Do you think international companies are poised to take advantage of it?
Well, some are and some aren't. And I actually, I've seen global businesses operating, along the entire spectrum of highly prepared, fully focused, getting the right market intelligence to a lot of them are still hoping for return to business as usual.
Yeah.
So I think over time, obviously, the winners will emerge. My two bits work is really that it has to do with innovation. When consumer markets, at the margin, is becoming more important in emerging markets. Innovation, the process of innovating for the consumers will then change.
Because the gravity has shifted.
Gravity is shifted, but the consumer taste and consumer needs and preferences are all very different now. It's a profound issue, and it would challenge global businesses to the extreme, to their limits, and it's not an easy challenge to meet either. But I don't think there's any choice but to really understand how businesses need to innovate for the future.
As economists and as business managers, we're always looking at GDP numbers, we're looking at growth rates, we're looking at our own expansion opportunities. But a question that's being raised more and more, you hear it from various pockets of society, is the realization that the world just can't keep growing. Now, all the time when we're talking about sustaining our economies and recovering, we're talking about growth. We're encouraging China to spend more, for India and other emerging markets to do so as well. But surely there has to be a limit to this. So my final question to you really is, as an economist, how do you reconcile what you know is true in terms of the way that consumer markets drive demand, drive our growth and prosperity, and the fact that the world will be clamoring for resources for fuel, water, food, commodities? It's a real dilemma, isn't it?
Well, it's not so much a dilemma as opposed to misplaced focus. And I'm so glad that you asked this question. To begin with, GDP is one of the worst indicators of economic growth. It sounds a bit strange, because it's supposed to indicate economic growth. GDP is just a flow.
Yep.
Okay. What we do not know from GDP numbers, including the national income and expenditure accounts and so on, is the quality of growth. And then, more importantly, as you pointed out, is the sustainability of growth. Now, get to the main part of your question, and that is, can we continue the way we have been, especially with emerging markets? More and more consumers are now demanding more and more what the wealthy countries got, and so on. Well, if you do a linear extrapolation, the answer is simple. Clearly, we cannot carry on like this. What we have to focus on, though, is how the quality of growth will change. In other words, in emerging markets, when you take China, for example, as the Chinese consumers are buying their first cars, buying their first condos, and so on and so forth, and you multiply that by the next 500 million people, you have a disaster on your hand. So the quality of growth has to kick in at some point for this process to be able to continue. So in other words, future cars that we will see on the roads of China will have to consume for the same mileage, say 10-15% of the fuel of the cars that you see in the road today. So the first aspect of quality of growth is efficiency. Growth can be achieved often not by just putting more input into the pot. Actually, reducing input in the pot delivers growth if you can maintain the same output. Right? Second, again, you look at China. China actually holds very good promise in this regard, and it's the shift from consuming consumer durables, to services. services by definition are a lot less resource intensive, a lot less raw material intensive. A very high quality service delivery, an example of it would be creating a concert. A concert is a very high-end service. People pay a lot of money to go to enjoy a concert. Just a whole bunch of people sitting there listening to a bunch of musicians playing. Okay, and that could be equal to producing probably 5,000 fridges. That's so much value. And services are much more in demand and easier to expand and evolve in urban context. So urbanization, the rapid urbanization in China actually sets the stage, I think, for a much faster transition from the usual consumption of durables to services and increasingly high-end services. And that's the future of the consumer market. So therefore, the answer to your question is that we need not see a stagnation or let alone a decline in consumer demand. But what we do need to see is a change in the demand of consumption that's shifting from low quality to high quality, low efficiency to high efficiency, and more importantly, shifting from consuming durables and goods to consumption of services.
Yuwa, there's so many topics that we could cover. Let's leave it there. Thank you very much for speaking to the Inside Bureau.
Thank you.
And good luck in Vancouver.
Indeed. Thank you.